In 1969, deep inside a tax reform bill nobody read past the headlines, the United States government buried a 6-page clause that let the richest families in America sell their fortunes without paying a dime in capital gains tax. And to this day, almost no financial advisor will explain to an ordinary person why it still works exactly the same way, completely legal, completely untouched, more than 50 years later. It's called the Charitable Remainder Trust. Section 664 of the Internal Revenue Code. Pause on that number because it matters later. The year is 1969. Richard Nixon has just signed the Tax Reform Act, a bill sold to the public as a crackdown on wealthy tax dodgers. Newspapers ran headlines about closing loopholes for millionaires, but somewhere in the fine print, lawmakers didn't close a door. They built one. A trust structure so specific, so quietly engineered, that it would take ordinary Americans decades to even learn its name. For most of that time, it stayed exactly where it was designed to stay, inside the offices of estate attorneys and nowhere near a public classroom. Here's what it actually does and why it shouldn't be possible. Say you own a stock or a business or a piece of land, and it's grown by millions of dollars since you bought it. Sell it normally and the IRS takes a cut immediately, sometimes 20%, sometimes more. But place that same asset into a charitable remainder trust first, and the sale happens inside the trust. No capital gains tax triggers. None. The trust then pays you an income stream for the rest of your life, sometimes decades, calculated off the full untaxed value of the asset. Only when you die does whatever remains go to a charity. On paper, it's generosity. In practice, for the families who have used it since the 1970s, it has functioned as one of the cleanest ways ever devised to convert a taxable fortune into a tax-free income machine, and the public conversation about it barely exists. Now, the official explanation. The government will tell you this was always meant for charity, that the tax break is the reward for eventual giving, and Congress simply wanted to encourage philanthropy among the wealthy. That's the story in every finance textbook. But it falls apart under one simple question. Why design an income stream that can run for 30, 40, even 50 years before a single dollar reaches the actual charity? Actuarial tables let trustees set the payout period so long, and the retained benefit so large, that in some structured arrangements the charity receiving the remainder gets pennies on the dollar of what the original asset was worth. The IRS has rules requiring a minimum of 10% go to charity eventually. 10%. Watch that number. It means 90% of the original design was never about the charity at all. And here's what makes it impossible to write off as accidental. The door was locked from the inside. In 1997, the IRS tightened rules on a related loophole nicknamed the Vulture Trust, where dying donors were exploited to shorten payout windows and inflate deductions. Congress closed that specific abuse within months. Fast. Efficient. Meanwhile, the core architecture of Section 664, the 50-year income stream, the 10% floor, the ability to defer tax indefinitely on the sale of an entire business, has never been touched. Not in 1986's sweeping tax reform. Not in 2017's overhaul. Not once. A tax provision this powerful, sitting untouched through 6 different presidential administrations and at least 4 major tax rewrites, while other loopholes get sealed within a single news cycle. Estate attorneys who have built careers on this exact trust will tell you, off the record, that clients used it to shelter the sale of shopping centers, tech company stakes, entire family businesses, legally, quietly, and almost never discussed outside a private office with a locked door. Go back to that 6-page clause from 1969. It was never about closing a loophole. It was about building one that would outlast the very reform it was hidden inside, a structure so specific in its design, so resistant to 50 years of tax law rewrites, that it looks less like an accident of drafting and more like something someone made sure would survive. Think about who benefits from a tax break the public never learns the name of. Every family office and every estate attorney knows Section 664 by heart. Most working Americans have never heard the words Charitable Remainder Trust in their life. That gap isn't an accident of complexity. Complexity has always been the design. The wider pattern holds across the tax code. The biggest advantages aren't hidden behind secrecy, they're hidden behind boredom, buried in language dry enough that no one bothers to read it twice. So ask yourself this. If a piece of the tax code has survived, unchanged, through 50 years and 6 administrations, built specifically to let fortunes pass through untaxed under the name of charity, was it ever really about charity at all? And if it wasn't, What else is sitting in that same 6-page clause, still waiting for someone to actually read it?